right, everyone, welcome back to Money Show's Virtual Expo. We are pleased to welcome Mish Snyder. She is the Director of Trading and Education Research for MarketGauge.com. With a passion for education, but a desire for bigger pastures, she sought out her own financial education by joining the floor of the New York Commodities Exchange. Mish Snyder spent 13 years on the floor as one of the only female traders. Currently, she has garnered tremendous attention due to her frequent media appearances as an expert analyst on popular networks such as Fox News, Bloomberg, CNBC Asia, and Yahoo Finance, and many more. Additionally, she publishes trading educational articles and videos, and has an award-winning book, Plant Your Money Tree, a guide to growing your wealth. Mish, thank you so much for being here today. It's all yours.
Thank you, Mark, and welcome everyone. So given that I have 30 minutes, I thought a lot about what I could do to really give you, I think, a great blueprint for navigating the market. And because, as Mark had mentioned briefly, I was an educator in special education, I like to teach. So I want to leave you with something, A, that would give you a blueprint, B, that you can actually learn readily, because as you'll see here with my questions, I'm a big fan of the 5 W's and the H, and then have some actionable information at the end of it so that you walk away with, if this happens, then I do that. So this is the introduction to my economic modern family, and I really want to cover today, what is it telling us now, but first give you a little bit of an introduction to them. So it's comprised of one index and 5 key market sectors. We've added Bitcoin as the newest member of the family. I'm going to go over each one of them, who they are, why they are important, and then we'll end with what they're saying now. Now you can notice here that it's who, why, what, where is going to be where they are now, and when, of course, will also be hopefully answered by the timetable that we'll see on the charts. So if you look at the picture here on the right, I am, as I said, a former special ed teacher who's been trading for 40 years, was on the floor of the New York Commodities Exchange. So a lot of my foundation comes from there. But this creation of the economic modern family was really a way for me to transfer from commodities to equities and be able to see it as a story. And what became apparent to me was that these key sectors in this one particular index really were the most reliable in being able to tell me a story, not only of what was happening when they were all working in tandem, but when they became disparate and what to do about that, and also good old sector rotation. So let's go through each one of them with a chart, and the chart is very up to date here, maybe a little bit behind in that this was created earlier today. But we're going to start with Granddad Russell, and I use the ETF IWM. Why would I choose this index over NASDAQ or the S&P 500 or the Dow Jones Industrial? Pretty simply is because this is 2,000 small cap stocks, all of whom are in the United States, heavy concentration on the industrial and manufacturing side. So as we've seen over the last 10 years, the growth mainly had been in the tech sector, of course, taking huge advantage of the zero interest rates that we no longer have, with a tremendous amount of stock buybacks, where these companies don't have the big bucks, say, of an Apple or an NVIDIA or an Amazon, Microsoft, Google. These companies are really working to keep the United States, in many cases, infrastructure going. And as a result of that, if this ever becomes the day where it starts to lead, that will really tell us that the United States is growing in a way that is more sustainable than just in the tech area. And the reason for that being, of course, is that if the industrial manufacturing sector is prospering, then our trade deficit actually begins to narrow in that we start to export more goods than we import. Because as we know, one of the biggest problems with the US economy is that goods have been produced, say, like in China, for much cheaper than what we produce them here. And that is why the growth that you've heard about from economists through the years have been somewhat artificial. So I depicted him as a little cute grandpa because he really is watching over the whole economy. And you can see some of the symbols here are in his basket, like, for example, Crocs and Buffalo Wild Wings, World Wrestling Foundation, FTT Flowers, etc. But if we take a look at the chart as of earlier today, what's interesting is I always like to use two major moving averages. I'll use others, but for the most simplistic way to explain, and I have to say extremely accurate as well, is the 50, which is in the blue, and the 200, which is in the green. Both simple moving averages, by the way, really can give us a full story. So what I like to look at is the price relative to where the moving averages are, the two moving averages relative to each other, and then the slope of the moving averages, because that gives you an indication of how quickly the direction of the price is moving in terms of picking up momentum in that direction. So we just kind of basically did it from March. And in March, what was interesting was that some of the other indices were still doing much better. The Russell had already broke down. In fact, it broke down, as I'm going to show you later, back in late 2021. But right now, what you can see is we had that one quick trip over the 50-day moving average. We never took out the 50. This is currently a bearish phase, as all the indices are in. But if we just go to more recent history, and we'll look at ranges later, this was actually in a range for almost a year where it traded above 200 to like 225, and it started to show the signs of the stress when it broke down under that range in March. And that's when we really started to see a more negative sentiment for everything. And of course, this was the big swoon that we had throughout April and May, when the Fed really started to announce that they were going to raise rates. And then, of course, the big rally that we had right here, up until we could not confirm getting over the 50-day moving average. So what the Russell is telling us is that it almost showed some signs of hope, but really where we are right now, and actually where we're trading as I'm speaking to you, which is a little bit lower at around 184, you can see right here that we're not exactly done where we can say this market's going way lower, but we can certainly say that from the low here at around 169 to the high at around 190, this 180 is going to be about a midpoint. And that's when we're really going to start to see whether or not the Fed's policies that come in, the CPI number that's come in, all of the different headwinds that the market is facing right now will actually be a negative further. And people who've called for the bottom will be wrong, and we'll see newer lows, or whether or not all the bears out there will be wrong, and actually the market will show more resiliency than what we think. Essentially, one thing you learn on the floor is price pays no matter what. And so with so much information, so much news out there, right now, I'm finding more than I usually do, and I'm a big macro type trader, that I'm really paying attention to the price and to these moving averages and to my characters in the economic modern family. So if we go to the next character, this is Granny Retail. Now you can see I actually am such a visual person that if I were standing here in front of you with my group of dolls, you would literally be able to think about these sectors in terms of a story. You know, so Granny is this cute little old lady. She goes to the mall. You can see all the symbols around her at the mall. She also is the granny of the US economy, because the retail sector is 70% or so of the gross domestic product. Now, Granny was actually one of the first ones to break down. You'll see again later when we look at the weekly chart, had a couple of fits and starts here, but never quite had the move that we just saw in Grandpa, where it tried to get past the 50-day moving average. This hasn't even come close. And actually what we see, not only has consumer discretionary, that whole area has completely fallen apart, but even consumer staples, which was carrying this market for a while when the inflation numbers first came out, also a part of this XRT basket, also is having some issues, like, for example, what you just heard with Target, having an over inventory of a lot of consumer goods that people are not buying right now simply because they're worried about feeding their families and fueling their cars. So Granny Retail can often be not only a lead indicator, even so more so than Grandpa Russell, because let's face it, consumers are everything here. But right now, what Granny is saying is we've gone sideways, hasn't really participated all that much in the big rally that we saw in some of the other sectors over the last couple of weeks. And if it breaks down under the 65 level range, probably shows a little bit more stress that's going to be happening in the market. Now, Big Brother Biotechnology is actually a very interesting sector. So he's a scientist, obviously, working that pharmacology. And this is where a lot of the symbols that we see in the biotech space live, like Acadia and Celgene and Amgen and Biogen, it goes on and on. So some of the symbols are represented here in the test tubes. But this has been a really particular interesting sector. And I love putting this one in the family because it shows two things. Number one is obviously during COVID, when Moderna vaccine and the Pfizer vaccine was starting to come out as the savior from COVID, the IBB sector did very well, but it was short-lived. And what's amazing about this particular sector is where consumers are more cyclical. And for those of you who don't know what I mean by cyclical, simply means that when the economy is doing well, that cycle in that sector will also do well. A non-cyclical means that regardless of what the economy is doing, that sector could still do well. Could be dragged down with the rest of the market, but will continue to overperform because in non-cyclical, it's not dependent on the economic factors. It's dependent on people's needs. And that's where biotech kind of fits in. So what's interesting with this one is that this too, kind of like what we just saw with retail, has really basically just gone sideways. And in 2008, after we had the huge crash, in 2009, when we started to bottom, the very first sector that bottomed and then started to bring up the rest of the market by rallying first and kind of poking its head out, that we've gone from disaster to maybe things are okay. What did people do is they went into the biotech space, obviously because we need our pharmaceuticals. And so this would be a really good one to watch if the market does go lower, to see if not only if it can hold this 105 level or close to it that it had, but whether or not it can actually start leading again. At this point, that's certainly not the case. Now, the next sector here is the semiconductor. So even though I mentioned in the very beginning that the technology sector, or I should say index of the NASDAQ, can lead for a while, and technology obviously has been a thing and will continue to be a thing and will probably be a thing and maybe be the thing in a digital world that will take us out of all of this as we become less dependent on things that are manufactured and more dependent on things that are actually more data-based or digital-based. And so semiconductors is a part of the family, and she is our mother, Semiconductors. And here she is with all of her symbols around her, like NVIDIA, for example, or American AMET. I've got all of a sudden the actual name of the company, but Advanced Micro Devices would be another, Microchip, et cetera, Marvel Technology, Intel, QCOM, Texas Instrument, et cetera. Now, this one often is the first one in the last several years that gets the buying, because people think, and I've heard this over and over and over again, as Mark mentioned, I'm a constant guest on many media channels, and sometimes I'm on with a panel, sometimes I'm on by myself, but I sit in the green room and I listen to people before me, and over and over and over and over again, I'm hearing people say, well, if you just stick to the companies with a good balance sheet, that are good companies that you know are never going to go bankrupt, and you buy those companies, you're not going to go wrong. And don't sell at a loss, because eventually they're going to turn around. Well, I don't like that thinking, but what's so interesting about the semiconductors is that it had outperformed for a long time, but we were always cautious on buying those rallies if we did not see Granny Retail or biotechnology or Russell 2000 following in kind. And so you can see the evidence of what I'm saying. Once again, after this bottom, this actually did clear the 50-day moving average. And remember, I said I like to look at slope, but the slope on this 50-day moving average is continuing to decline. So it kind of told me that, along with the fact that XRT never cleared the 50, IBB never cleared the 50, and IWM just cleared it recently, but only for a day, that this rally too was going to be short-lived. So you can start to see how this whole family works together. And of course, as I'm talking to you right now, this is actually sold off a lot more. It's trading down at 233. So much for those people that are going out and just saying to people, oh, go buy Apple, go buy Amazon, go buy Microsoft, you can't go wrong. No, the family is telling you that there's a lot of pressure there. And even though the retail investors like to buy in this area, they're also going to be the first areas to sell off. Now, the next member of the family here is the regional bank sector. I do not like to look, I shouldn't say I don't like to look. I have not included the big banks as part of my economic modern family for a reason. Bank of America, Wells Fargo, Citibank, et cetera, they have their own thing going. They have big investment parts of their bank, whereas the regional banks really will take a pulse of what's happening in the more urban areas of the United States. And so even though people think it's very simple, interest rates go up, banks go up, it's not that simple. So here we have our good old boy here. This prodigal son thinks y'all should be giving thanks for them regional banks. You can see his little nemesis here, his cat, and some of his symbols like Key Bank and Zion and PNC Bank. So essentially, right now, this has also tried for like a couple of days to get through the 50, but we still have a very sharp declining slope. And because regional banks are a part of the family, sometimes, not often, I've actually seen them lead in that when they start to go up, it kind of gives you a first early warning that people are actually going back out of their communities, borrowing money to build homes, to start businesses, to send their kids off to school, or whatever it is, home improvement, et cetera. And so that's really more important to this than the actual interest rates. And of course, we know in terms of savings right now, people aren't saving money. They're actually charging up huge credit card debt. That ultimately is not good for banks. So what we're seeing here is further stress all over the economy, including in the regional banks, and not necessarily as sexy as everything else I showed you, but we should pay attention to these two bottoms right here, because if the rest of the market comes off and this holds this double bottom here and starts turning around, it's possible that regional banks could tell us that people are in better shape than we think, in which case then we should start to see some action in the consumer retail space. The next family member here is transportation. Now, I like to think of the consumer space and the Russell 2000 space as the supply side, right? Goods that people buy. And this, of course, is the demand side. So planes, trains, and automobiles, as you see in my picture here. And really, probably one of the most important areas to look at in the economic modern family, because let's face it, if we're not seeing demand, whether it's people traveling or freight moving or ships being delivered, like in a FedEx or UPS, or some of the airline stocks would be in here. Some of the trucking stocks would be in here. The rail stocks would be in here, like Louisiana Pacific, for example. If you're seeing all of that weak, even with those little blips we saw in semiconductors and a little blip we saw in regional banks over the 50, this never even got close. This is telling you the whole story here between the consumers going away right now and the demand starting to slack off. Are we in for more pain? Certainly the story of the modern family is we can have a bright spot here and there, a little rally here and there, as we've seen, and people will flock to the areas that they know, like chip technology. But overall, things are really still looking pretty weak. And unless we start to see, I'd say, probably even more reliant on than regional banks, although that's something to look at, unless we start to see retail or transportation reverse that move. Right now, we're saying could go lower, but at the very least, we know we're in a trading range. And if you look back to May, all we did was come close to test the top of the May range. And now it looks like we may get close to testing the bottom of the May range. So we're really in this very tight range here, which, by the way, is very typical of a stagflation environment that we're also in. So that's all my modern family characters. And now we're going to take a look at cryptocurrency here. So cryptocurrency, and we're going to really focus on Bitcoin. And the reason why we're focusing on Bitcoin, obviously, is that it is the oldest of the cryptocurrencies. It's 13 years old. And I like to include this now. It's been in the modern family for a few years because it really doesn't know yet what it wants to be when it grows up. It's such a typical adolescent, right? So we went through this period of time where Bitcoin was well outperforming the market, and the buzz was that it was a hedge against inflation, and it was more in favor than gold as a hedge against inflation, and all of the stuff that you heard. And it was even kind of thriving in the face of China banning mining, and then some of the other countries following in kind. And then, of course, now we have other countries that are adopting it as its currency, and then we have more and more adaptation from the mainstream with payment systems, et cetera. Even the government is getting on board now. So when I say it doesn't really know what it wants to be yet when it grows up, I think it's because it's gotten so much attention, both negative and positive, that we still don't understand what Bitcoin is going to be to us in terms of the economic factors. And right now it's looking a little bit more risk off in its bearish phase, or whether or not it's going to depart or decouple from the rest of the market because of the blockchain technology, and because eventually people will turn more and more to using alternative currency, and in this case, Bitcoin or some of the other altcoins, as a way of currency, and banks will go the way of the dinosaur, which of course many people believe, including people like Kathy Wood, who's all about the disruptive technology. So what are we seeing here? This actually doesn't have quite as clean a pattern as we saw in some of the others, but it does have an extraordinary period of consolidation. If you just take out this little wick right here and you go from the bottom of this wick all the way straight across, you can see we have had a tremendous amount of support around 28,000. And if you go to the top, it's almost in perfect alignment with the 50-day moving average. We've had a tremendous amount of resistance at 33,000. Now, I would not necessarily say that it's going to be a given that if Bitcoin, let's say, takes out 33,000, it's good for the rest of the market. It might be. And this is where we're really sort of doing price discovery on how Bitcoin actually relates to the rest of the economy. We don't know that yet. But what we do know right now is that it's still, if you look at the S&P's performance versus Bitcoin's performance, the Bitcoin percentage-wise is up tremendously compared to the S&P over the last 5 years. So in relative performance, Bitcoin is still doing a whole lot better. But right now, it's just trying to figure out, can it survive any other pressures we're having in the economy? Because let's face it, if consumers are impacted, that would include buying anything with Bitcoin, number one. And number two is if the retail investor is impacted and they've taken a bit of a hit in Bitcoin because they were getting long near the highs, then they too might be more aside with cash. So I keep my eyes very carefully here, but like I said, I can't tell you definitively yet whether or not Bitcoin will go up and that's good for the rest of the market, or Bitcoin just goes up and separates itself from the rest of the market. So now I wanted to show you these weekly charts because I really like looking at weekly charts, because weekly charts tell me a bigger, longer term perspective. And in the beginning, you saw that I wrote a book, and that book was called Plant Your Money Tree, A Guide to Growing Your Wealth. And I'm going to give you a link at the end where you can actually get a bonus for you sign up and buy the book. But the book uses weekly moving averages. So this blue line is the 50-week moving average, and the green line is the 200-week moving average. And so what's so interesting about this is, remember I told you I was going to go back to the beginning of 2021 to give you some perspective. So let's start here in the middle with our grandpa, because I told you we had this insane trading range that went from pretty much the beginning of 2021 all the way until we finally broke it in early 2022. This thing held like that 212 to 210 level like a rock. Every time it went down, it bounced. Every time it went down, it bounced. We had this peak move up in October, November of 2021. So it broke out of that range quickly and briefly. And then it came right back into it, stayed in that range, stayed in that range, stayed in that range. And it was the first one to break down. This is why it's so important to watch the Economic Modern Family. This broke down in October, November 2021. And I specifically remember going on shows like Charles Payne, Making Money with Charles Payne, and telling him, I am not bullish this market because the Grandpa Russell has shown me that it's breaking down under the 50-week moving average. Now, let's take a look what's happened since then. Yes, we've broken that range. Will we ever get back through 210, 212 again? Maybe. It could be years. But what we have seen is that it's held the 200-week moving average. So think about 200 weeks, right? So 200 weeks are about 4 years. So in a 4-year period, which is not quite a business cycle, but close to a business cycle, we're still showing this is where some hopeful signs that the economy isn't going to go into a recession could be seen and reflected right here in the Russell 2000. So actionable information, essentially looking at that 50-day moving average I showed you before. If we can get a couple of closes over 190, maybe we'll head back up closer to 210. However, on the flip side, and we're right smack dab in the middle here, so it's very hard to figure, but I would say if we start to see a move down under 180, this 200-week moving average of 176.50, we get a weekly close under that, and I think we have more room to the downside. Okay, so that's very important to think of right now. If we move over to the left here, same kind of thing happened with Granny retail. So Granny kind of held this level or around 89 to 90 also for almost the whole year. Also made that one big spectacular move up and then broke down just a little bit later than Grandpa, but broke down because the consumer was a little bit last and has not seen any action above that 50-week moving average. And now you can see that we are here once again. We tested that 200-week moving average, but the consumer is not dead yet, could turn out to be dead completely if inflation continues and rates keep going up. So if we get back through 70, that would be my number. I would also look at that 50-day moving average. Maybe we can see a move back up to 80. That would give you a very short-term trading opportunity, and that's all we're thinking about these days right now, because even if it breaks down under this 200-week moving average, maybe we go, oops, sorry about that. Maybe we go down a little bit further, but I also believe that we're not going to see this big crash that people think. I think we're going to see some level of a new trading floor to be established, but it'll be frustrating and continue to be frustrating the rest of the year. If we move over here to the right, this is biotech. Now look, this is under the 50. So, if you want to look at some foreshadowing here of what happens in an instrument when it breaks down under the 50, pretty much at the same time that the Russells did, and then holds for a couple of weeks the 200, breaks it, holds it, breaks it. You can see this kind of chop. That's what I'm talking about. It doesn't necessarily mean death, but it does mean we'll find a new trading range, just like we did here in biotech. And then eventually, if we start to see continued weakness in the market, you might see a new leg lower in the Russell or in the retail sector. But right now, I would say if this can clear 120, and these never break down under the 200 week, also possible that these will hold up And we might actually see that little bit of rally in the biotech getting us back up closer to that 200 week. If we move down over here, this is our semiconductors. Remember now we're a little bit closer here. The 200 is well below. The 200 in this comes in at around 180. I'm sorry it was cut off. And so we have a long way to go to test that. And look at the momentum here. So remember I told you about slope. Huge slope down, huge slope down, huge slope down. Just now starting to turn down, which means the semiconductor sector, the place where people go habitually to buy, may wind up actually getting hit pretty hard if everything else I just mentioned to you starts to come to pass, like this breaks down, and this can't get back through 120. So there might be a tremendous opportunity there. And then just to kind of follow through on the last two here, here's transportation also above its 200, hasn't quite gotten down there yet, but again, accelerating to the downside, didn't have quite the spectacular trading range that we saw in the others, but did have a nice triple top here with lower highs each time, kind of gave us the warning that even though it was above the 50-week while the others were breaking, things weren't looking that pretty. This was sort of infrastructure news that hasn't really materialized. And yet we have tremendous amount of support here at 212. And to wrap up here with our regional banks, same thing, still above the 200 week, so it's got a long way to go, but also has broken down under the 65 level, would really have to do something tremendous to get back over this 50 week. And so if you put it all together, XRT, IWM, the real inside sectors along with IYT, could hold, they could hold, but if they break, it's going to be trouble. The semiconductors can certainly break even harder on its own. Biotech may not break so hard and actually may be the savior after all. And of course, regional banks right now will follow probably down what the consumer market is doing if they're going to really start to pinch their pennies, which they've already started. So last thing I want to show you just in terms of contacting me, my Twitter is @MarketMinute. If you write down this link, you get a bonus trading video on the phases, those moving averages I just showed you. That's a $97 value you'll get for free. And every day we publish Mish's Daily, and that is at www.marketgauge.com/daily. And that will give you everything I talked about today. I give you day-to-day insights on what the market is doing vis-a-vis the modern family. And then sometimes we get into some of the other surrounding sectors as well. So thank you so much.
All right, Mish, thank you so much for that fantastic presentation, taking the time out to talk to our audience. Thank you very much again.
You're very welcome, Mark. It's been a pleasure. Oh, yes, and come see me in the Money Show in Orlando, end of October. I will be there.
Excellent. Thank you so much for that plug. I was just about to mention that. So everyone, if you do look on your screen, check out the Money Show Orlando. It will be taking place October 30th to November 1st. We are at the Omni Orlando Resort at Champions Gate. Beautiful property. So be sure to come out and see more great presenters, just like you heard today with Mish. So thank you everyone for being here. We'll be back in 2 weeks with another virtual expo. So be sure to check that out on moneyshow.com and be sure to register for the Money Show Orlando. Thank you so much for being here. Good night.